all I want is a stable market, but every deal is different. That's for sure. And so stick to your fundamentals.
Hello, everyone. Welcome to another edition of Ask the Multifamily Expert. And I'm super excited to have Clark Finney with us today. Clark Finney is going to just be like a chat. We really want to know your opinion about what you feel about the Fed. But before we go right into that, I would like to inform people why we've decided to do this event. And simply, it's just for people to learn and ask questions so they can continue on their multifamily journey. We know sometimes it's difficult to just get the right information, especially when it comes to multifamily. Everybody seems nowadays to be an expert, but it's important that you get it directly from the source. People that are already doing it and they're masters or experts in this game. This week we talked about cost segregation in multifamily and also in single family. It's a very important session because of what is happening in the economy. For those of you that have seen my videos recently, I've been talking so much about the post-tax rate because we know that the federal government is intending, we don't know, but we believe they're going to do that. They're intending to cut tax rate. Now, the thing about it is, what do we do in preparation or as soon as it happens? What are the opportunities we should grab, or what are the cautions we should start putting in place? And today, there's no other person that will help us define or tell us more about the steps and strategies we need to start doing. And not just for multifamily, but also for your personal homes and all that. It's going to be giving us the Fed's perspective and what he feels we should be doing at that point. But before I allow him introduce himself, I would like to say this. If you're not following us on our Facebook page, then you're missing out on great content. We cover everything A to Z about multifamily from beginning to the end. We bring experts. We also educate people on asset management, on acquisition, anything about multifamily for you to continue on your financial journey. You can go to our Facebook page. Someone is going to put it on the screen. If you are not following us on our Facebook, on our YouTube, it's Blue Ocean Multifamily Group on Facebook, and on Instagram is Blue Ocean_multifamily, and on YouTube is at Blue Ocean Multifamily Group, where you have all the content on multifamily and many more. I would like to introduce Clark Finney. So Clark Finney, I've known him for a while and he's been a very fantastic broker to us. And let me give you this quick story about why I like the relationship that we've created over time. It's because one of our deals we're trying to close on, I remember 2 weeks to the closing, the lender pulled out. And it was so devastating because we had about 500,000 in under contract. And this was a very singular word Clark told us. Clark, I don't know if you can remember this, but this was very consoling from you. And you said, Bibi, don't worry, I will take care of it. I will ensure that you get another lender that will carry on this debt. You'll be fine. And that was all we needed. And truth be told, he delivered on his promise. He got us a lender that met all our requirements, even better requirements. And that was it for me. And I said, going onward, I was going to use the services. And that's what we've been doing since then. So after this event, you can connect with him. He's so dedicated and committed to meeting his clients' needs. So Clark, we really want to know who Clark Finney is.
Absolutely. Thank you very much, Bibi. I remember that deal. That was a lot of fun, and I think is a very well-performing deal for you guys now, post-close. I think Bibi and I have this, kind of joke between the two of us that if it was easy, everybody would do it, and it definitely is not easy. But it's worth it to you. The juice is worth the squeeze too. It can definitely be profitable in a lot of different ways. Anyway, my name is Clark Finney. I'm the head and director of capital markets here for Matthews Real Estate in Dallas. We cover capital market needs for debt and equity placement across the country. However, my team in Dallas focuses mainly in the southeastern part of the United States. So Texas through the Carolinas, Florida, Oklahoma, maybe a little bit of Missouri, maybe a little Illinois here and there. But for the most part, that's where we thrive. And my core specialty is multifamily. always has been since I was an underwriter at Freddie Mac myself, managing an annual pipeline of $6.5 billion. So quickly realized that I didn't want to, be in the public space for my whole career. So I transitioned into the private sector as a consultant, advisor, broker, helping strong professionals across the country, structured debt and equity like Bibi on, deals across the country. And we have a whole lot of fun doing it, but every deal is different. That's for sure.
Every deal is different. Before we go into the business of the day, I would like to tell the audience, if you're on Facebook or you're currently with us on the webinar, you can throw in your questions in the Q&A session at the box in the Q&A session, or you can just raise your hands after question and answer. Anytime you feel like asking questions, please go right in, ask the question or raise your hand. Then we'll give you the mic or just read out your questions. So Clark, what is happening in the economy? Recently, we heard that the Fed is looking at cutting rate. What do you think would be the short-term effect and also the long-term effect of that?
Absolutely. The Fed cutting rates has been long awaited and it's very exciting, right? I think that some of the key benefits of those rate cuts will be more immediate than most people think. But I think that there is also a misconnotation that, if the Fed cuts rates by 25 bips, for those of you, 25 bips is 0.25%. Every 0.01% is a bip. So 25 bips, quarter point, 0.25%. There's a misunderstanding really that's fundamental to real estate. That is, people believe that if Fed cuts rates by 25 bips, every loan rate across the country is going to go down by 25 bips. And that's not necessarily true. In some cases, with banks, that could be true. But once you get into deals that are larger, especially with agency deals, that is not necessarily true at all. Because, effectively indexes like treasuries, which is where Freddie and Fannie price deals off, are based off of the bond market. And the bond market price is based off of what the future expects, right? So if you say that the Fed is going to cut rates by 25 bips, the bond market's going to move like the federal government will cut rates by 25 bips. The day they cut those rates by 25 bips, that pricing has already been accounted for. So there's not any more movement. And that's a big misunderstanding for most people while they're navigating the next, call it 12 months of rate cuts. While it is and while there will continue to be a benefit with generally rates going down, do not expect that we will get back to 2021 levels of interest rates where you could get a 3% rate. I think the lowest rate I ever did during that period of time was 2.91. And that was for a $53 million Class A multifamily, like new delivery project. But I don't suspect that would happen again. They cut rates by a lot during COVID and during the GFC in 2007. But apart from a massive economic, disruption, you're probably not going to see rates like that again.
Yeah, sure. We are very sure we will not be seeing rates like that. So to understand what you're saying, you are saying that with a 25 or 50 bp, we might not see a significant shift in interest rates for multifamily. Is that what you're saying?
I think that's fair. If I can share my screen here, I can probably show you something here that I think is pretty interesting. What I'm going to show you guys is basically a forward curve. Forward curves have been wrong before, but a forward curve is generally, as of today, an expectation of where rates are going to be based off of people making investments in Wall Street on where the bond market is going to be, right? And so you can almost use a forward curve to ask, am I at the bottom of the market? Am I in the top of the market? Will rates be going up or down over the next 5 years? And I think that that's a really helpful tool to reference that I'll send a link to in the chat while you're going through and trying to evaluate opportunities here. Can you guys see this?
Yes, we can.
Okay, so this is the forward curve. Right now, as of October 2024, they expect the 10-year Treasury to be at 3.83. And then as a result of Fed cutting rates, it will probably dip to about 3.8. And then over time, that'll gradually continue to increase, especially as the duration goes further. And this is kind of more of an estimate, pure estimate. Right here is probably more of like an educated guess, right? But what you don't see is that there are rates that are going down to 2 or 1, right? And I think we could also use the fact that the 10-year Treasury is currently below, it's at 3.66 today, which is a lot of movement over the last 3 months, right? And that movement is pricing in the future Fed cuts, right? So a lot of that benefit has already been priced into the market. And then based on that benefit, where do we expect it to go tomorrow? We're already well below the future forward rate curve, which goes to show that realistically, over the next 12 months, we may see, overall indexes starting to trend up. And maybe what we're experiencing right now is not just a continuation, but potentially, like a brief bit or dip, which gives an opportunity to a lot of real estate investors to be able to buy fruitful opportunities that yield a lot.
Oh, okay. Right now, you're saying that we've taken the benefits already, but it's going to be a long-term role play for us to see the total benefits, correct?
That's correct. I think this right now, I think we were going to talk about this a little bit more down, but I think it's a great opportunity to bring it up. There's an article that I wrote that I'll send over to the group as well, but it really kind of pinpoints that there's a brief period of time where it takes cap rates, which is a metric that you use to evaluate properties, right?
Mhm.
Cap rates take around 6 months ish to adjust to changes in rates, right?
Yes.
And so, especially since we saw this back in end of 2022, when you had rates, starting here and then blasting up, it felt like it took almost 2 years for the market to realize that older vintage property in a secondary market isn't a 4 cap, but it's actually like a 6.5 cap. That took 2 years for the market to come to those terms. Now, when it does benefit the seller, that will be faster than 2 years. It'll probably be like 6 months. But what you find here is that there's a great opportunity to realize that, this started going down about a month ago dramatically. And there's potentially about 4 months left, maybe between now and the end of the year, where you're in a 6.5 cap market and you're able to acquire that deal at a 5.5 to 6% interest rate and make a good spread based off of what the cap rate is and what your actual rate is on the loan. And that will yield positive returns day one. That's what we call to be positive leverage, when your cap rate is higher than your interest rate. And this is when you can find that in this brief period of time before cap rates adjust downwards and you may have a 6.5% or a 6% rate on your loan and a 6% cap rate. And it doesn't necessarily mean that's a bad deal. It's just that means that it's not going to be as profitable if you had a 6% loan and a 6.5% cap rate. You following?
Yes, I'm following. A question just came in. What are the key opportunities for borrowers post-rate cut, and how can they capitalize on these lower rates while still being conscious?
That is a great question. Okay, yeah. So what I would do is look at this chart here that I can also send. This is kind of illustrating what I was just talking about with the relationship between cap rates and interest rates. Not only will it help your returns, but it'll also help your ability. Can you guys see this?
Yes, yes.
It'll also help your ability to get better leverage, right? So, for example, the tough part about getting leverage last year was that all the cap rates were still at about 5.25,
Yes.
whereas our interest rates were like at 7.5. And that's because of that relationship. Most of the loans that we're sizing were at like 50% LTV. Maybe if you were lucky and got a 6.5 interest rate, you could get 55% LTV. Bibi and I sized plenty of deals where that was the case last year, right?
Yes.
However, now when we're in an environment where you can get a 6% cap rate and a 6% rate, now you're getting closer to this 70% range. And that's less money that you need to raise. That's more money that you're borrowing at 6%, rather promising investors a cash on cash of 8 or 12%, something like that, right? This is generally going to be a fundamental improvement over what, we've been experiencing, which has kind of generally been this kind of section of the grid. And I think we're going to start approaching, kind of closer to this section of the grid, which is obviously improved.
Good. Very, very good. Besides the lower interest rates, we're also looking at higher leverage from the lenders, and also it's going to help the debt service coverage ratio, correct?
That's correct. That'll help the relationship between your interest rate and your cap rate. Your cap rate is a function of the cash flow that the property makes.
Yeah, as a few months ago, they could not refinance their property, and property was performing well, but because of the debt service coverage ratio and the cap rates, they could not exit. So, would this be a good opportunity for them? Maybe in 6 months' time, take advantage of the cap rate shift, maybe in their local market, and try to see if they can refinance or get a debt quote from their lenders. Is that something investors should look at?
That's a really great question, and that's very relevant today. Similar to what I explained earlier, where most people, especially people that have been in this industry for 25 plus years, but maybe aren't super focused on economics. They're really just kind of focusing on, like, I know how to run my buildings. I don't really care about economics. I just, ago, but I know because I've been doing this for 25 years, I know everything. There are a lot of people that are misinformed like that, even though they've been doing it for a long time. I think what a general mistake they're making is that, yes, they have a loan, they need to refinance. Yes, there is a maturity in the next 6 months. However, right now the deal sizes for them that allows them to be able to refinance without a cash in. Maybe in fact, they're able to cover closing costs and walk away with a little bit of money with today's rates, right? And what I would recommend is to say, realistically, if the deal works today in an environment that we currently know, then execute on it. Don't expect you have the ability to beat the market or that you're smarter than the market, because at that point, that's hope. You're just hoping to beat the market. And that hope is not a strategy at all, right? So if a deal works, then I would rather execute on it today than waiting around thinking it's going to get better and it doesn't get better. And now the deal actually maybe will not, you're going to wish that you did it. I think that's a very, very helpful tip.
Yes, so people should take advantage of the opportunity if they see the room to do that now than waiting to see if it's going to get better. That's what you're saying. And I think
if it works now, do it. Even if it's close to working now, do it, because I can't guarantee you that it'll work in 6 months.
Correct. Yeah, there's a question here, but before I go ahead to ask you this, I want to know right now people are running away from bridge loan, and that's because of what happened. People took bridge loans 2 years ago and they can't exit. Some of them are already underwater because either the property is not performing or they can't refinance it. So, and some of them are selling below the market price and all that. So would you say this is a good time to, let's say I have a very big value add product, property or a deal, and it's not stable, it's below 90% occupancy, and it has a lot of value add that I need to do. Would this be a good time, since the market is about shifting, would this be a good time to try bridge loan? Because for me, bridge loan is not on my radar right now. So I try to avoid it, but I want to know your perception about taking that as an option of structuring your deal.
Yeah, absolutely. I understand. And as a person that was very active in that market, many people were misinformed. Unfortunately, the fact that even though SOFR in 2021, which is an index they use for floating rate loans, was zero because it was new and it was COVID, floating rate loans seem to make all the sense in the world because SOFR was so low. It was only like you were paying like a 3% rate. You're like, I'm a genius. I get all this leverage. I get 85% of the purchase price and I have a 3% rate on a floating rate deal. What's the worst that can happen?
Exactly.
Well, unfortunately, what happened is that SOFR went from 0 to 5 in a matter of maybe 6 to 9 months, right? And so your 3% rate went to an 8% rate overnight, right? And that was faster than what many pro formas were able to achieve as far as being able to have an income that was greater than your debt service. And so thus a lot of groups were underwater. Now, that same function, while it did hurt a lot of people, can actually be a benefit in an opposite interest rate environment. It became a cancerous product for many people that saw the rate environment go from a low environment to a higher environment. But if you're going into something that's a floating rate product and you're in a high environment going to a low environment, there could be a lot of benefit in that for you, especially if you're doing something like a bridge loan that allows you to buy maybe a distressed asset at a really great cost basis. I did a deal that closed 2 months ago where the price per door was lower than what it was back when 3 owners purchased it 3 owners ago, right? Back in 2014. What if I told you you could buy a multifamily deal in Texas in 2014? Would you say that that would be a pretty good investment?
Yes.
It absolutely is. Yes. I wish that I buy multifamily in 2014. And what you're finding here is that there are opportunities right now to be able to do that. Now, they're not everywhere, but there are opportunities like that. So back to this chart here. You know how I said how the 10-year is kind of just going to continue being flat? Well, let's take the 10-year out. This is SOFR, right? This is SOFR. This is where it went from 0 to 5.3, and that's what really hurt a lot of bridge loans. Well, in this environment, we're in a rate cutting environment. And so SOFR reacts differently and more closely aligned with the federal funds rate than where the treasuries really kind of interact. And so you can say that every time they cut rates, SOFR is going to go down a little bit, right?
Yes.
And you can see that between now and maybe late next year, it could fall by 2%, right? To being a 3% floor, which means that if you have a 3% spread on a 5% deal, yeah, you have an 8% rate today. But if you're able to negotiate your index floor to being 3% or lower, then that 8% rate could easily be a 6% rate on a really good leverage short-term loan that you just negotiated a benefit to yourself by being able to maximize your cash flow because your debt service is lower, right? And
Mhm.
that right there is one of the best tips I can give you. And from an institutional perspective, what a lot of REITs do, what a lot of large institutional groups do, when they're in a low interest rate environment, they fix low long-term fixed rates.
Right. Yeah.
Right? They fix everything they can at 4%, 3.5%, and they fix that for 10 plus years.
Yes.
Right?
Yes.
But when you're in a high interest rate environment going into a low interest rate environment, institutional money says that you should be in a floating rate product because you can get something at the top of the market and be able to ride the benefit.
So my question to you is, are we in that environment? What kind of environment are we right now? Because I read an article and it said we are having a turn. The turn just started. But I want to know from your own perspective, are we there yet? Are we at that point where we're taking a turn on the economy?
Yes, I think that there is a lot of data that shows that when it comes to commercial real estate values probably bottomed out in early August. And you can see that being indicated by large institutions acquiring multi-billion dollar portfolios. And these are groups that are smarter than me. They're smarter than everybody in my office combined. They all went to Harvard. This is all they do full time. And they've been doing this for 25 plus years. And so they are able to understand, when is the most opportune time to buy. And they triggered their transaction activity to begin basically a month ago because they know what they're doing and they're going to go and buy at the bottom of the market. And so we don't really have to be Harvard graduates. All we have to do is copy the Harvard graduates.
Follow, copy and paste.
Right, exactly. Follow the money, right? And so what you can expect, I guess, is that, typically bottoms of markets last around 3 to 6 months, and we're 1 month into it. So I would expect that you are going to find a very rich acquisition opportunity over the next, call it 3 to 4 months. Call it the end of Q1 2025. You're going to start to see corrections in values going to where they start increasing more and more and more.
Okay.
Which can be a good thing if you're an owner already and you want the asset value of your current real estate to go up because cap rates are going to start going back down. But not so much of a good thing if you're a buyer because now, back to the PDF that I had here,
Cap rates will be.
now your cap rates are going to start growing down and
Yeah.
your leverage is going to stay just around the same, right? So instead of being with a 6% rate at a 6.25 cap, getting 70% leverage, you may be getting 60% leverage at a 5.5 cap. You know what I'm saying?
Indirectly, this is going to be a favorable market, not too long-term period for sellers. Yeah.
Generally favorable to both buyers and sellers in different ways, but not at the same time.
Wow. Okay. So as a buyer, what should I be cautious of? Taking advantage of the entire market shift.
A lot of people that got into the market in 2020, for better or for worse, they've been operating and navigating in this market that can arguably be the most difficult market to navigate in the last 20 years, right? And so with that being said, the fundamentals haven't really been fundamentals because everyone's been kind of learning on the fly, right? There has been no stable market for people to really understand like, oh, cap rates have usually always been here and incomes and rents have usually always kind of stabilized here. Between now and 2020 or since 2020, cap rates have gone up and down by 300 basis points. Rents have gone up and down plus 30%, minus 30%, right? Everything's been so volatile that it's really been hard for us to, especially for groups that haven't been doing this for very long, understand where the market performs once it's stable, right? So in a stable market, this asset rents for $1,200 a month. Say that inflation's out of the picture. That's all fixed. In a stable market, this market for this kind of deal is a 6 cap, right? I think that what some mistakes people can make is that, when they're looking at deals, they look at, oh, well, in 2023, 2022, this asset was leasing for $1,400 a month. So I'm just going to set my pro forma to $1,400 a month because of course they're going to get that rather than looking at what other comps in the area are actually getting today, right? That's your real competition and metric. In addition, oh, well, if they're going to cut the Fed funds rate by 2%, then that means that my cap rate, I can use an exit cap that's closer to 2% below what it is today, which is like a 4 cap. And that's not necessarily true, right? Because you're probably in a five cap market. And if you assume your whole pro forma based off of an extra $200 a month per unit and four cap exit, yeah, everything would look good. But the reality is that if you do that, it's a mistake. And what you're not doing is focusing on fundamentals. You're focusing on what it's been kind of like a short term memory. And so that's what I would tell people to look out for is to just, while it is always attractive to make your exit cap 25 bips less than what it probably is because it makes the whole pro forma better, you have to fundamentally understand that the market cap rate for an asset is what it is, and your opinion is not necessarily that much of a part of it. And so stick to your fundamentals. Long-winded answer.
I think that's the best word we've heard today from you. Stick to the fundamentals. That's why some deals that were closed 2 years ago are currently having issues because some people were sticking to the current market and actually forgot the fundamentals. And that's what Clark is trying to remind us today, that we should learn to stick to the fundamentals because the market can actually shift. But if you do your best by sticking to the fundamental, you know that, yes, right now my rent projection is going to, let's say, 10%, but the fundamental says this market has been steadily increasing by 2% for the last 10 years or 6 years. But because of the market now is at 10% rent increase, I think you should stick to the fundamental of the 10 years trend rather than the current one. And I think that's the mistake some people are making. I saw an underwriting of someone and his rent projection was almost 20% increase. And I was like, where in this world are you going to get this in this market? And the deal was so good, 34% IRR, returns 3x and all that. I was like, this is not achievable and realistic. Clark, I have one more question from you. So based on the way the market is turning, how will brokers or lenders underwrite? I know you said it at the beginning when you were showing us the chart, but right now, are they more cautious or they are more flexible because the market is taking a shift?
What I would probably recommend, the way that lenders are going to underwrite deals between now and I would assume the end of this volatile cycle, which I hope is the next 12 months, for everything to kind of just like people have seen the final reactions to the market after they've cut rates, and the market is kind of stabilized, and to be clear, you know, all the capital markets industry wants, all I want as someone who structures debt and equity is a stable market, right? Don't get me wrong. There are plenty of opportunities for people to make a lot of money acquiring and selling assets as principals in a volatile market because you can time it correctly using different instruments efficiently in order to make really good yields and returns. But from a guy that, whose core job is to make sure that a deal closes the way that it was, structured to close, we need a stable market, right? And after 4 years of living in anarchy, I'm very much looking forward to a stable market because that's going to make every execution a lot easier. As far as like where they're going to underwrite deals, I think what you can expect is that there's a lot of fears of a recession coming up. Some say that we're already in one, some say that one is coming. But I think that what you can expect is that especially on bridge lenders are going to be more conservative on rent growth over the next, call it 24 months than they maybe would have been if there weren't so many headline fears of a recession. I think that there's an obvious election coming up as well. As far as like, the effect that elections have on the commercial real estate industry, I think it's fairly reasonable to say that it's minimal. They probably have more an effect on the stock market than anything. But as far as their effect on the commercial real estate industry, I don't think one candidate winning over another candidate historically hasn't really had much of an impact on cap rates or coupons. It has had more of an impact on the S&P 500, but this is a conversation about commercial real estate. Apart from probably lenders being a little bit more conservative about rent growth and projections, just because no one really knows what's going to happen over the next 12 months, one way or the other than rates are going to be down. That's really it. I think generally speaking, people are more optimistic than they were last year and certainly more optimistic than they were the year before. To kind of add one piece to it, I go to an annual conference for lenders and brokers. It's in San Diego every year. And once a year, roughly around like March, what you see is you probably get 250 top brokers in the country with like the 500 top lenders in the country all getting together and they're having little meetings and they're all kind of like networking and talking to each other. And in 2022, when I attended that conference, it was depressing. All of these lenders were like, the sky is falling. All of these brokers were like, I'm not doing any deals. This is awful. And then in 2023, last year, it was like, oh, well, it looks like the end is in sight. This is pretty good. Looks like, 2025 is going to be a pretty good year. And I'm excited to see, how the energy is in March of next year. I'm confident that it'll probably be a little bit more optimistic than it has the last 2 years, which is a good thing.
I thank you so much, Clark. Before I ask you the last question, I know I said last one before. I would like to say this to the audience. The right time to start investing is yesterday. Regardless of the market, start buying real estate, but do your due diligence, buy right, and talk to people like Clark Finney to get a very good quote and a perception of the economy. I do that regularly with him. I jump on a call with him and I normally ask questions. And that is just to help me with my projections or where I see the market going. It's important that you have relationship with your loan broker. I always say this. Your loan broker, your insurance broker, your broker for getting you deals are very, very important relationships you cannot afford not to have. And you can see the wealth of knowledge that Clark is just passing on to us. Right now, I've gained a lot, and I'm sure you have as well, gained a lot from what he has said and how we should take advantage of the opportunity, but at the same time be cautious about it. So Clark, do you think after this rate cut, which we all know will happen in few days, you think another one will happen in December, or you think that's it for the year?
That's a great question. As far as like what the Fed rates are gonna, how they're gonna cut rates over the next 24 or
Right.
between now and the end of the year.
Yes.
So I have this fancy little tool that I like to use that I like to call the Vegas odds. I'll pull this up and share my screen one more time. So I can send this as well. This is called the CME tool, and it basically targets probabilities and Fed cut movements based off of forward contracts in the bond market, right? As I said earlier, the bond market reacts to where believe the economy will be, not necessarily where it is today. And so you can almost take a look at what those same investments and forward contracts in the bond market will be and put probabilities to based off of where the bond market is performing today, what the Fed could possibly be doing over the next 12 months, right? And so just kind of focus on this here. Right now, we're at 525 to 550, correct? As of today, there's an 87% probability that Vegas is projecting a 25 bip rate cut next week on September 8th.
I think I agree.
Right? And I agree too. A lot of people were saying 50 bips, and I
50,
think
yeah.
that's kind of crazy.
That's a very chain for me.
Let's go into November. Right now, it's kind of 50-50 that it will either be, a 25 bip cut or the first 50 bip cut.
You
Which
think
at
they
that
want
point
to
is
do anything?
75.
You think they want to do anything during the election period? That's November.
Well, exactly. I mean, you could probably find opportunities. Like, again, if you believe that the elections don't necessarily have that much of an impact on commercial real estate, and this, but a lot of other buyers don't, right? You could find yourself being one of few bidders on an opportunity and getting a good deal on something. Right. But I think as far as this is concerned, the investors are 50-50 on, a rate cut of 50 bips to 25 bips. Now let's fast forward, to May of next year. Where is the Fed going to be of May of next year? And there's a 36% chance that it'll be a full 1% below. Actually, no, that's 2% below where we're currently at today.
I don't think so, but let's see.
I mean, I hope so. I hope so.
There's
if you had 25 plus 7, really 25 plus 8, there's a 30% plus chance that the market is pricing in that we're actually more than 2% below where we are today, which I think is pretty wild. You add the 36 plus the 24, that's probably what? More than 50%, closer to 60% here, that it's going to likely be 2% or less. But I mean, I think that that's a really good estimate, March of 2025. So what is that? 6 months away, in 6 months, we'll probably be somewhere, 1.5 points below, more than likely where we are today. And that will come with benefits. The true question is I think what we got from this call is don't assume that the benefits could be more aggressive than what they likely could be, right? And take advantage of the opportunity that you have now, where there's a really good window of being able to get solid leverage with a decent interest rate of 6% and targeting 6.5% cap rates to get really good leverage and strong returns. All right. And to try to be as active as you can before this 6.5 gets closer to 5.75 and you have less leverage with maybe a marginally lower rate. You see what I'm saying?
Yeah.
And I think that's it.
Thank you so much, Clark. So, guys, we need to take advantage of the opportunity right now. Let's not wait till tomorrow. Let's start on the right and let's start talking to brokers now and getting those deals under contract. Clark, to end, do you have any last word for the people? I know you just said one now, but I don't know if there's any other last word you want to tell the audience. And that's one. Secondly, how can they reach you?
No real last words, but you can reach me at Matthews Real Estate. You can Google my name, or I will send an article that I wrote about kind of generally what this relationship is here that Bibi you can forward to your group. And my contact information should be in that article as well.
Fantastic. So, guys, we'll be sending everyone an email just after this event, and it's going to have Clark's all the things he just told us was going to send. We're going to put them in a link for you to look at and start taking your decisions. Start buying things, start investing, start making the move, and start discussing with the experts. Thank you all for your time. And before we go, I would also like to remind everyone to please go to our YouTube channel. You can watch a replay of this on our YouTube channel and other ones we've done. We've spoken to a lot of experts in the industry. You can go to the YouTube channel and watch the replay of those conversations we've had, and also my take on the market and also how to properly manage an asset and buy an asset. I also did a live due diligence of a property on my YouTube page. So you can go there, and if you are buying a property and you're looking for how to go about your due diligence, that might be a good article or a good content for you to go through. Thank you so much, Clark, for spending this time with us. We are really, really happy that you just guided us in how we can navigate the market post interest rate cut. Thank you so much and have a wonderful day. Thank you, audience. Thank you for coming, and expect an email from us. Okay, someone said, thank you, Bibi and Clark. This was an incredible Zoom. Much appreciation to the both of you. Thank you so much, Kim. And Bob Evans said, thank you so much, Clark. Great information. And thank you, Bibi. Thank you so much, everyone. I'm sure everyone enjoyed spending time with you. Thank you all and have a wonderful day.